Hi there, welcome to Kneppyinvests. In this video today, I am going to address one of the most important questions we have, or can have, as an investor, or more particularly as an equity investor. Because if we can understand this fundamental question, we are halfway there to becoming a successful investor over the longer term. 2 days ago, I did a video on Reliance Worldwide Corporation, and I mentioned the term multiple expansion a few times in that video. And I came away from doing that video with the thought that there's going to be some viewers who don't really understand that concept of multiple expansion. And I thought I should address that in a video. And as I was thinking about how I could address that question of what is multiple expansion, I realized that if I broke it down into its most fundamental parts, the question isn't about answering what is multiple expansion. It actually comes back to what ultimately drives share prices of companies higher or even lower. So in this video, I am going to address this fundamental question that we should all have, particularly those new investors. What drives share prices higher? Because when we invest in a company, that's what we want to see with the share price of those companies we have invested in. We want to see the share price go higher over the short, medium, and long term. But what actually does drive that share price higher? So hopefully in this video, if you're unclear on this question, hopefully this video will clear up some of your questions. As I was preparing this video, I sort of jumped straight into the most important things, what drives share price higher. But I was missing this one fundamental step. And I was thinking about this when I was taking for the dogs out for their usual 2-hour jog and walk this morning. And I realized to start off this question of what drives share prices high, we need to know a simple understanding of what is the share price of a company. Because if you understand what the share price of a company is, that's the sort of the first step you must take before you understand what drives the share price higher. And the best way to understand what something is, particularly in mathematics, is to know any sort of formula or equation. So those who hate mathematics, unfortunately, I'm going to show you a mathematical equation here. Now, fortunately for those who don't like mathematical equations, it's actually a very simple one. And I was trying to understand how you can derive a formula that shows what the share price is. I initially thought that's almost impossible. But then I realized it's actually really easy. And it all comes back to valuation metrics like the PE ratio. So what is the PE ratio? It's simply the share price divided by the earnings per share. And as soon as you understand what the PE ratio, you can see it has share price in it. So simply because a mathematical equation that has a share price in it, we know straight away we have a formula that shows you what the share price is. So if you just fiddle around with the different parts of the PE ratio, you come out with the share price is simply the PE ratio times by the earnings per share. And as soon as I saw that, I realized I missed this step because the two things I was going to talk about which drives the share price higher is related to the PE ratio and is related to the earnings per share. Therefore, in the simplest terms, for the share price to go up or down, we need the PE ratio and the earnings per share itself to go up and down. We also can see the PE ratio and earnings per share go up or down, so there can be a combination there as well. But that's the ultimate, those two things are the ultimate drivers of the share price from the very short term to the long term. It's the PE ratio and the earnings per share. At this point in time, you might be a little bit confused about the PE ratio. Hopefully, the earnings per share is simple enough. It's all about the financial state of the company. It's all about the earnings, which is profits. I use operating cash flow. So if those increase through time, naturally enough, the share price of a company should increase, but through time. But what is PE ratio, and how can we determine how the share price is going to move up or down through the P ratio. So that's what I'm going to talk about in the next slide. Many investors use the P ratio to judge the relative value of a company they have invested in or a company they are thinking of investing in. So the very definition of P ratio, it is a valuation metric. Now, personally, I prefer to use enterprise value to operating cash flow as a valuation metric. That's just my own preference because I prefer to use enterprise value over market cap, and I also prefer to use operating cash flow over net profit. Now, that's a whole different video in my opinion. Now, I've got in brackets there continuous. And the reason I've got continuous there is because the P ratio changes with every trade that happens in a day. That's if the share price goes up or down in that trade. So it's a continuously changing part of the share price equation. But when we look at the enterprise or the earnings per share, which is the other part of the share price equation, it is not continuously changing. These are the financial numbers the company reveals to the market every 3 months or 6 months. So in America, they reveal the numbers every 3 months. In Australia, it's every 6 months. So the earnings per share or the profit or whatever you look for there, operating cash flow, that changes. It's every 3 to 6 months. It's not continuously changing. So we can set that in stone. So it's usually the P ratio that is continuously changed. So if we understand what changes the P ratio on a day-to-day basis or even a minute-to-minute basis, we get a better understanding of what drives the share price higher or lower. So let's have a quick look at the P ratio definition right now. And this is straight from Investopedia, if I remember correctly. And their definition for the P ratio is shows what the market is willing to pay today for a stock based on its past or future earnings. Now, you can actually change that to pay today to say to pay this very minute because, again, it's continuously changing throughout the trading day. And the most important parts of this definition is what the market is willing. And that's all about sentiment. So I mention a lot in my videos that the main driving force of the share price in the short term is sentiment. And that's actually in the P ratio definition here. It's what the market is willing to pay. But the other important part of the P ratio is right at the end. It's for a stock based on its past or future earnings. And so that future earnings is very important there. It's all about expectations. And that's why I'm always looking for profit or earnings upgrades for companies because that changes those future expected earnings. So the P ratio is sentiment or emotionally driven and expectation driven. So sentiment plays a part and also expectations plays a part as well. Now we know what ultimately drives a share price higher. It's all about the P ratio or sentiment and expected earnings. And it's all about earnings per share or the profit the company releases every 3 to 6 months. Now, well, how does multiple expansion and financial expansion play into this? Because these are the two bits of terminology I use frequently. Well, multiple expansion is simply the P ratio or valuation metrics like enterprise value to operating cash flow rising through time. So whenever I say multiple expansion, I am referring to the changes in the P ratio or those other valuation metrics. The opposite to multiple expansion is multiple contraction. And that's on those situations when the P ratio goes down with time. So you can also look at those sort of situations for an explanation why the share price is actually going lower. It's multiple contraction. And financial expansion is just increases in the net profit after tax or operating cash flow. And we get those increases 3 to 6 months. So multiple expansion and financial expansion are the ways the share price can go higher through time or does go higher through time. Those are the only two ways. And we know that because of the share price formula, which is just equal to the P ratio times earnings per share. To make sure we are on the same page, what is my definition of multiple expansion? It's actually when the market is willing to pay a higher premium for a company. So for instance, the PE ratio might rise from 15 to 30. And when that happens, that is multiple expansion. It's all about what the market is willing to pay for a company. Or you could also say if there's been any increase in expectations for future earnings. For instance, profit upgrades. So that is why I'm always looking again for profit upgrades. It's because we might see a bit of multiple expansion that drives the share price higher. Unfortunately, it's not as simple as saying the way that share price increases is through multiple expansion and financial expansion. You can get a combination of those two, and we haven't even really discussed multiple contraction and financial contractions. So there actually are 5 ways a share price can increase. The first way is through multiple and financial expansion. And in these situations, we will see the share price of a company run up quite hard. I'm always wary of these setups because when you do see multiple and financial expansion, there is a possibility the market is getting a little bit too hot, a little bit too frothy for a company, but it can continue for quite a while. So I'm not particularly looking for situations where I see multiple and financial expansion. Financial expansion with zero multiple expansion. This is one scenario I am looking for. So if you do see a company whose share price is increasing because of financial expansion and the P/E ratio is remaining quite steady, that does lead to potential opportunities in the future because you might see some multiple expansion put a rocket up the share price. The third one is something I haven't really seen that often, and that is multiple expansion but zero financial expansion. You do see it occasionally. In fact, this has happened with Apple over the last 5 years where they've seen significant multiple expansion but very little financial expansion. And in these sort of situations, I am very wary because the market is getting a little bit too excited about a company. The fourth one is maybe my favorite scenario, but it's also a scenario you do have to be a little bit wary, and that is financial expansion. So the company's profits have been increasing and multiple contraction. The P ratio is actually falling through time. And this does open up opportunities to buy into a company that is great value. But you also have to question why there is multiple contraction going on. Why is the PE ratio falling? Potentially the market is expecting this financial growth in this company to come to an end. So you do have to be wary when you see financial expansion and multiple contraction. And the final one is multiple expansion and financial contraction. Potentially the worst sort of scenario because the company's financials are going down, the profits are going down, but we are still seeing their PE ratio go up. I haven't seen this sort of scenario play out all that much, but I did find one recently on the ASX. I'll actually show you that example later in this video. Later in this video, I'm going to show you some real-life examples of companies going through multiple and financial expansion and contraction. And these examples are going to be of very well-known companies in the world. So if you haven't heard of these companies, I think we should have a chat. But before we get there, I'm going to show you some hypothetical, simple examples of multiple and financial expansion. Hopefully this can explain what I've been talking about through this video because these are very simple explanations, hopefully. So just imagine there's a company that just IPO'd on the stock market, and on day one, the share price of this company is $1 and the P ratio is 10, which means the earnings per share is 0.1. 100 days later, on day number 100, the share price has risen to $2, so it's doubled. That means the P ratio is now 20. So the share price has increased from day 1 to day 100, all because of multiple expansion, because between day 1 and day 100, the company has not released any new financial numbers. the profits have remained the same throughout that period because there has been no new information from the company. But then on day 101, the company announces that the profits and earnings per share have increased by 50%. Now, if the share price remains at $2, that means the P ratio is now 13.3. So the P ratio has increased from day one from 10 to 13.3, and the earnings per share have increased by 50%. So both the earnings and the P ratio have both increased. So that is financial and multiple expansion. For all these examples, I'm going to use the exact same scenario about this company that this is on the ASX on day number one at $1 with a P ratio of 10. So with the financial expansion and no multiple expansion, just imagine the share price has increased by $1 or 100% from day one to day 100. Now, the P ratio has increased to 20. So you might think, well, that's multiple expansion, but you're talking about no multiple expansion. I don't understand. But just remember, the P ratio can rise because of sentiment and because of expectation. So there is potential in this scenario that the market is expecting profits to double when they release their results on day 101. And just imagine that's exactly what happened. The company announces profits have increased by 100%. And that means if the share price remains at $2, and it should because the company has hit the market expectations, that means the P ratio goes back to 10. So there has been no multiple expansion when you take into account the financial growth in this company. So the share price increase from day 1 to day 101 has been because of financial expansion, but there has been no multiple expansion whatsoever. Now to the situation of multiple expansion, but no financial expansion. And the exact same scenario where on day 100 share price is now $2 and the P ratio is 20, all because of multiple expansion. Now, for some reason, the company has now announced that profits remain unchanged. So from day 1 to day 100, the market is not expecting profits to double, because if they were expecting profits to double, the share price would not remain $2. But in this example, the market was not expecting any growth in this company, and the share price remains at $2. So the P ratio is still 20. So from day 1 to day 101, the P ratio has grown from 10 to 20, but the earnings per share or the profits have not changed at all. So the share price has increased solely because of multiple expansion and no financial expansion at all. Now to the situation where there is financial expansion and multiple contraction. I'm not going to talk about multiple expansion and financial contraction. Hopefully this example will clarify that as well. Now, a slight difference than the previous examples we have used. So this company has listed on the ASX at $1, P ratio is 10. But instead of the share price doubling, the share price has halved to 50 cents on day 100. So that means the P ratio is now 5. So the share price decreasing from day 1 to day 100 is all because of multiple contraction. The company hasn't changed their profits at all. Maybe the reason the share price has decreased because the expectations of the market have lowered for the company, or because there is really bad sentiment around this company. Now then on day 101, the company announces that the profits or the earnings per share have increased by 100%. The market is shocked by this announcement. But if the share price remains at 50 cents, the P ratio would actually be about 2.5, or maybe a little bit less than that. But because this announcement shocks the market, the share price actually triples to $1.50. So the P ratio is now 7.5. So the share price has increased from $1 to $1.50 because of financial expansion. The EPS has increased by 100%. But the P ratio has dropped from 10 to 7.5. So there has been some multiple contraction there as well. So this is a situation that you can see on occasion on the markets. Now onto some real life examples. And in all these examples, I've shown you these charts looking at three particular pieces of information. We do have the price, which would be the blue line, sort of the lightish blue line. The price to operating cash flow, which is the black line. And that's sort of like a P ratio proxy. So that's looking at multiple expansion. And then the cash flow from operations, which is the red line. And you'll see the share price and price to operating cash flow be a little bit more volatile than the cash flow from operations, because companies only release their cash flow from operations on a 3 to 6 month basis. So it's a little bit more smoothed out. So what I'm looking for here, if you see the cash flow from operations go up, that's financial expansion. If it goes down, that's financial contraction. If you look at the price to operating cash flow, the black line, if it's going up, that is multiple expansion. If it's going sideways, it's neither. If it goes backwards, that's multiple contraction. And of course, the share price, if it's going up, the share price is increasing. If it's going down, the share price is decreasing. In all these examples, I'm going to show you how the share price has increased through certain periods of the chart time. So for realestate.com here, it's a 10-year period. In the next 3 or 4 examples, I forget how many examples I do have, I won't reveal what company we're looking at until I finish talking. So between 2011 and 2014, realestate.com's share price, and it was increasing during that period, was going up because of financial and multiple expansion. We can see the cash flow from operations increasing, and we also can see the price to operating cash flow increase as well. But we saw the multiple expansion stop towards 2014. In fact, the price to operating cash flow went sideways between 2014 and 2020, and the cash flow from operations kept on increasing. And we also saw the share price increase through that time. So between 2014 and 2020, the share price for realestate.com increased because of financial expansion. There was no multiple expansion happening at all during that period. But that all changed in 2020. We saw significant multiple expansion happen with realestate.com in the past 18 months. In fact, the price to operating cash flow has grown from about 26 or 27 to 64. Significant multiple expansion happening in that period. We've also seen the share price grow by a considerable amount. But when you look at the cash flow from operations, it's actually gone backwards. And if you look at the correlation between the cash flow from operations and the share price from 2011 to 2020, there was a nice correlation there. They were both increasing. That has changed over the past 18 months. The cash flow from operations has gone or detached itself from the share price moving up. So we've seen multiple expansion and financial contraction in the past 18 months for this company. Now, this sort of makes sense to me because I've heard a lot of really positive chat about realestate.com in the past year and a half. So there's a lot of excitement still around this company, even though the financial performance of realestate.com has gone backwards in the past year or 2 years. The market is expecting that not to be long-term, that to be completely different in the next few years. And they want it to be different because we've seen significant multiple expansion in the past 18 months. And if the financial state of this company doesn't improve, we will more than likely see the share price of this company drop off a cliff in the next few years. Sometimes in my videos, I will show this sort of table looking at the growth rate of revenue, profit, operating cash flow, and then compare it to either the share price or the market cap. And typically what I want to see is the share price growing over a certain period of time at the same rate as revenue, profit, and operating cash flow. Preferably, I'd like to see it increasing at a lower rate. And this is for realestate.com and looking at 15-year period, a 10-year period, and the last 5 years. And over the last 15 years, share price has been growing at similar rates than the revenue and profit and operating cash flow. That's good. But a lot of that was because between years 15 and 10, we didn't see the share price or the market cap of this company growing at the same rate as revenue, profit, operating cash flow. But if you look at the last 5 years, realestate.com's revenue, profit, and operating cash flow has slowed down. This company is becoming more mature. So you shouldn't be seeing a significant increase in share price like we did see about 15 years ago. But the share price has been increasing at 23% per year over the past 5 years, even though profit has only been increasing at 5% per year. And just looking at those numbers immediately tells you there has been significant multiple expansion happening with this business in the last 5 years. There's been a little bit of financial expansion because revenue, profit, and operating cash flow have been increasing, but share price increasing at significantly higher rates than those three financial metrics is a dead giveaway that the reason this company's share price has been increasing is because the P/E ratio keeps going higher. There's more and more premium to realestate.com's share price. And again, that makes sense because the amount of positive chatter I've heard about this company has been insane over the past year, year and a half. Second example I want to show you, and again, I won't reveal the name of this company until I finish talking about them. If you do have the insight, you can see these companies' code in the top left. So try not to look at that. But anyway, this goes back 10 years, just like we saw in realestate.com. And from 2011 to 2016, we did see the operating cash flow of this company increase. Share price was increasing at a slow rate, but the price operating cash flow was going sideways, sort of trading in between about 12 and 7. So through that period, there was financial expansion happening because the cash flow from operations was increasing. But then in 2016, it all flipped. And from 2016 to present, the cash flow from operations has stalled. We haven't seen any growth. In fact, from 2016 to right now, it's almost identical level of cash flows from operations. But the share price has completely taken off in that time period because we've seen significant multiple expansion. The price to operating cash flow has increased from 7 to a current 23.28. So the market is pricing a little bit more premium into this company's shares. And this all makes sense because I've heard, again, a lot of talk in all the podcasts I listen to raving about this company. So even though the company has not been performing financially, it's all because of sentiment. It's all because we've seen the P ratio climb higher and higher. In fact, back in 2016, the P ratio of this company was 12. And it was around that time that Warren Buffett bought into this company because the valuation of the company was quite low, even though we were seeing the cash flow from operations of this company increase. In fact, back in 2016, 2015, the sentiment in this company was actually quite negative in the market. So this company is, if you haven't figured out already, Apple. Third company I want to look at is a fascinating chart. This goes actually all the way back to 1997. And again, try not to look at the top left because some people might figure out what this company is, but this is a perfect example of how sentiment can drive the share price of a company. And if you look at the cash flow from operations for this company, it's actually continually increased through this last 25 years. So you should expect the share price to increase throughout this period as well. But there was a long period of time here between about 2000 and about 2012 and 13, where the share price of this company just went sideways. There was no increase in the share price. And the reason there was no increase in the share price was because back in 1999-2000, the price operating cash flow for this company was really high. And then we saw a long period of multiple contraction lead to the share price just going sideways, even though the cash flow from operations was improving. So between 1997, or just around that time, I think it was about 2000, and 2013, this company experienced financial expansion and multiple contraction, and that led to the share price really not doing anything at all. And then all of a sudden in 2013, things started to change for this company. In fact, we saw financial and multiple expansion, and you can see their share price really take off over the last 3 years. And it's really been helped by an improving financial state, so the cash flows has really started to take off as well. But we've also seen a period of multiple expansion for this company. In fact, the price to operating cash flow has increased from 8 to about 30. So this company is, if you haven't figured out already, Microsoft. A really interesting chart, and it does also show you do have to be wary when the valuation metrics, in this case price to operating cash flow, does get a little bit high. You can experience a long period of time when the share price does nothing because the financials have to catch up. But over the last few years, we've seen significant growth in both the cash flow and the multiples of this company. And that's why the share price has really taken off at an exponential rate over the past 4 or 5 years. On to one of my favorite companies in the world, even though I don't own them, and I don't have any idea why I don't own this company. I do think they have the ability to take over the world eventually. I say that in half jest, but there is that potential. And the other reason I love this company is because the reason why the share price is or has been rising is really easy to explain. So this chart goes back to 2007. And from 2007 to now, the price to operating cash flow has just gone sideways. It hasn't really changed. You do see little bits of ups and downs in it. But if you go back to 2007, it was between about 24 and 30. And right now it's 29. And the reason why the share price hasn't been increasing is because the cash flow continually increases. In fact, there's almost a perfect correlation between the share price increases and the cash flow from operation increasing. You just see that red line and the blue line go up at almost the same rate. So the way I look at this company is the reason why the share price is increasing is all because of the financial state of the company. There's no hype in this company, and there's no lack of hype in this company as well. It's simply priced the way it should be. And if you had to choose any way to price a company, it's all about the financials. And that's why this is one of my favorite companies in the world, because if you think the operating cash flow or the profits will increase at 20% per year over the next 10 years, more than likely the share price will increase at 20% per year over the next 10 years because there won't be much multiple expansion during that time period. And this company is Amazon, one of my favorite companies in the world. And I did a video on this company end of last year, and that's when I discovered this simple fact that the driving force of this company's share price is the finances. There is no hype in this company at all. Last company I want to talk about and show you as an example, I'm going to reveal the name straight away. It's CSL. And there's two reasons why I decided to look at CSL. The first reason is I listened to a podcast yesterday that featured Rudy, I won't try to pronounce his last name, from FN Arena. And he stated in that podcast that the best two quality companies on the ASX was realestate.com and CSL. And I just mentioned the realestate.com. There's a lot of positive chatter about that company, and that's just one example. The other reason I wanted to look at CSL is because another famous podcaster in Australia always has a go at CSL because of the lack of real free cash flow. And this podcaster loves Apple because they believe that company experienced significant increases in cash flow. We've already had a look at Apple, and over the last 5 years, there's been no increase in cash flow during that time period. So I do believe sometimes we do have biases, and I think this podcaster, who was doing Motley Fool, now is a Seven investor, I forget what it is. I think he has biases, and he just can't let go of the biases, even though there is proof that Apple has slowed its growth, has become a very mature company, and CSL wasn't experiencing free cash flow because they were spending a lot of money in capital expenditure for growth. But if you have a look at cash flow from operations, we have seen significant growth in this metric. So I do think bias can have an effect on your decision making. So this is CSL going back about 5 years. So a little bit more noisy than the other ones. But between 2016 and 2020, just before the COVID-19 financial panic, we saw financial and multiple expansion with this company. You can see the share price increasing, cash flow from operations increasing, and the price to operating cash flow also increasing. So this company's share price was increasing because of those two reasons. But things have changed since around about the start of the COVID-19 financial panic. The cash flows from operations in CSL have continued to increase. but the share price has gone sideways or even backwards a little bit. So even though cash flows from operations have increased, the share price is not reflecting that. And we have seen the price to operating cash flow fall off a cliff because of that. In fact, it's fallen all the way from 54 to a low of about 24 a few months ago. So this company is becoming more exciting because it is going to continue to grow through the long term, yet the price to operating cash flow has pulled back. So we've seen a period of time here, almost a 2-year period, where CSL has experienced financial expansion and multiple contraction. And again, that is a sort of situation I'm looking for, because in the long term, these sort of situations can give you the best returns. So what do I personally look for? I do look at this all the time. Every single time I look at a company, I just want to see why the share price has been increasing over a long period of time. So the longer, the better. And the main things I'm looking for here are financial expansion. I'm always looking at the revenue, operating cash flow, and profit increasing through time. And if it is increasing through time, I prefer to see very low or zero multiple expansion, or preferably, if I'm comfortable with the future growth of a company, multiple contraction. And a lot of times when you do see a correction in the market, that's when you do have multiple correction. That's why when you see significant decrease in the overall market, that is a good time to buy into companies that are likely to experience significant growth in their financials over the next 5 to 10 years. That is all I have for this video on what drives share prices higher. If you have been confused about this very question in the past, hopefully I have illuminated some of the questions you might have had and solved some of the mysteries that have been in your life since you've started investing. If you still have any questions about this topic, I'd love to hear your questions. If I haven't explained something clearly enough, leave that in the comments section. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.